Okay, so let's tie up Chapter 16 with a few loose ends on corporate compliance work. So we know corporations are taxed at 21%, and all the progressive tax rate structure that used to exist with the 34, 35, 38, 39, that's all gone. Control groups are still around, however. So the idea is it used to be that you could think of it like taking a single corporation that makes $1 million and splitting it into a bunch of smaller corporations that all make $50,000 and therefore taking advantage of progressive tax rates. That's why controlled groups were invented, but they're still around. And the idea is you're going to treat a group of corporations as one corporation for determining certain tax benefits. And even though it's less important because of a single flat rate structure for corporations, it still does apply. So, for example, we talked about the gross receipts test of $25 million back in Chapter 9. So that $25 million is measured using controlled groups. So you would have to combine together all the parent, sub, or brother, sister entities in order to calculate the $25 million. So corporations report their taxable income on Form 1120. We've talked about Schedule M1. We've talked about Schedule M3. We know that the corporate due date for tax returns is April 15th. So that's not really 3.5 months. That's the 15th day of the 4th month. There is an exception for June 30 year ends, but we're not going to worry about that. There's an automatic 6-month extension for filing, so that would take them all the way through October 15 if they were a calendar year-end corp. And then there are some weird differences on extensions for a June that I'm not going to ask you about. So consolidated tax returns are essentially when you have an affiliated group and you're going to treat them as a single corporation. So again, a little bit beyond the scope of what we need to worry about. So when it comes to paying taxes, I know up to now we've dealt with this wonderful kind of perspective on if I wait till next year for a deduction, I get a whole nother, or I have to wait a whole year for the tax savings. And that simply really isn't true. So hopefully you've noticed that over time, through the withholding system, individuals pay. And corporations and self-employed individuals both have to make what's known as estimated payments. So these next few slides deal with corporate estimated payments. So if a corporation has a liability of $500 or more, they're required to make estimated payments in 4 installments during the tax year. And you can see the dates are the 15th day of the 4th month, then the 6th month, then the 9th month, and then lastly the 15th day of the 12th month. Now, I want you to make a special note of these dates, because notice that you're paying the 2nd, 3rd, and 4th quarters before those quarters are actually closed. So that's going to play a part in the way we do these estimates later on. So if in fact you underpay, a corporation may owe a penalty. So how do you decide if corporate underpayment results in a penalty? Well, there are 3 safe harbors that a corporation can lean on to try to avoid a penalty. The first is if they've paid 100% of the tax liability on their prior year return, then they can escape any penalty for underpayment this year. If they paid, and that means that, so let's say, for example, the corporation owed $1 million in tax last year, and as it turns out, they owed $1.2 million this year. As long as they paid more than $1 million this year, that's what that safe harbor means, that they've paid equal to what their prior year liability was. So, and then there's another one that says, of course, if you pay 100% of your current year tax liability, you don't have a penalty. Well, no kidding, that makes sense. And then the last one is a little more complicated. And it says you have to have paid 100% of your estimated current year tax liability using some form of annualization method. And I'll show you an example of that annualization method in a bit. So rules for large corporations, and the measurement of a large corporation from this perspective is $1 million of taxable income in the prior 3 years, is they may only use that safe harbor for the prior year's liability with their first quarter payment only. And again, I think you'll see as we work through these quarterly payments how that is supposed to work. Okay, so Potter Corp has estimates of income for 2018. So at the end of Q1, it expects that in the first 3 months, it's going to make 1.2 million of taxable income. Q2, 2 million, and then by the end of Q3, it's up to 3.5 million. And notice that there's not a fourth quarter estimate because, of course, the fourth quarter is the last quarter of the year. You don't estimate anything. You just close your books and figure it out. Okay, so here is from your book the method you use to annualize income. So we're not making estimated payments yet with this table. We're simply estimating what the taxable income would be. So look, for example, at the first quarter, right? So if my first quarter estimate of income is 1.2 million, then of course my estimate for the year is 4 times that, or 4.8 million. Notice that in the second quarter, I'm also using a 3-month estimate of my taxable income. Recall why that's true. Remember that payments due on June 15 for a calendar year end, which means that I don't even know what my second quarter is yet. So I continue to use my first quarter, therefore multiply by 4, I get a full year's estimate. By the end of the second quarter, by the end of the third quarter, now I can use the second quarter's estimate of 2 million. That's halfway through the year. I multiply it by 2, and I can get an estimate for what I think the full year is going to be. And then lastly, after Q3, I now have 3 quarters worth of estimate, or 9 months. I can use that, multiply by 12/9, and get what I think the full year is at the end of the third quarter. Okay, so now I've calculated estimated taxable income at the end of each quarter. Let me show you why that is important. Okay, so this table is also from your book, and you can use it to calculate what is your estimated tax payment that's required. So we'll start with column 1. I just filled in the information from the previous schedule we filled out on the last slide. Then I estimate the tax based on that taxable income. So since we have a flat tax rate, 21%, 21% times 4.8 million is $1.8 million. Do the same thing for the second quarter. 4 million times 21% is 840,000. And then by the fourth quarter, when my estimate for the year is 4.6 million, then my tax is estimated at 980,000. So you can see in column 3, that's how much of the tax you're required to pay. So of course, with each quarter, you're required to pay a quarter of your income tax. So we can calculate out what our payment is for the first quarter. That's the 1,008,000 times 25%, or 252,000. We haven't made any payments for the first quarter. Now, you can actually have payments for the first quarter. Those are often if you take last year's refund and decide to apply it to next year's tax. In this case, that didn't happen, so the required payment is the 252,000. Now we skip down to the second quarter. We know that we have the same estimate for annualized income of 1,008,000 times 50%. Now I'm up to 504,000. I've already paid 252,000. That was my first quarter payment. So my second quarter payment is another 252,000. Now let's move down to the third quarter, where my estimated tax is 840,000. Now I owe 3 quarters of that tax because I'm 3 quarters of the way through the year. 75% of 840,000 is 630,000. I have previously paid in 504,000. That was my Q1 and Q2 payments, which means I owe another 126,000. Then we come down to the fourth quarter. My estimated tax is 980,000. I now owe all of it. My previous payments are 630,000, so I need to make the additional 350,000. And as long as I've made payments based on those amounts and I haven't fudged my annual estimates in a way that is fraudulent, then there won't be any penalty on this corporation as long as I pay it in. Okay. That brings us to the end of video 16E on a few corporate compliance items, and it brings us to the end of chapter 16. We move on to chapter 18 now. Thanks for watching.